Well, good morning from Duck, North Carolina, on the outer banks of the of North Carolina coast. I think this is the furthest out into the Atlantic point in the United States. So maybe my next video, maybe I'll turn the camera around and show you what it's looking out my window. So this is the view from inside the room. And the purpose of this little mini lecture here is to review the exam number one. And to maximize the learning opportunity here. So I would suggest that you have, you go through each question. When we get together next in class, I'll give you back your exam papers, but don't wait till then. Go through each question with me now, and let's go through the logic and kind of lessons learned on each one. So as you know, there were 20 multiple choice questions, and there were 4 short problems. So I'll take the multiple choice questions, and let's work through this. There's a technique to taking multiple choice questions. So one of the things I certainly recommend, a couple of things. One, before the exam, was to simulate exam conditions. I don't know how many of you did that, but I suggested you lock yourself in a room for an hour and a half, give your best shot on the exam, then come into class and go over the exam. So your next exams 2 and 3 are very similar format, so you should be more familiar with the format here. And if you don't already do it, what you might want to do is, as you study the material, is at the end of each chapter, go through the multiple choice questions at the back. That's a good way to review the chapter, and it's also a good way to get used to taking multiple choice exams. So first one, which of the following events cannot be quantified into dollars and cents? So when we say quantified into dollars and cents, we mean we record them in terms of the accounting equation. You do not everything that happens to a business has an effect on the accounting equation. So the one that cannot be quantified of the choices there would be the appointment of a new CPA to perform an audit. Yes, that's important to have a new CPA firm, but that does not affect the accounting equation. So the correct answer there is A. B, C, and D would all have an effect on the accounting equation. Number 2, the body of theory underlying accounting is not based on, well, generally accepted accounting principles, commonly known as GAAP, is concepts, principles, definitions, theories, conventions. So the one that it's not based on is the physical laws of nature. So there's nothing to do with gravity or relativity or other natural laws in there. So, but concepts, principles, definitions are all part of generally accepted accounting principles. Number 3, the accounting equation can be expressed as, so the basic accounting equation is assets equals liabilities plus owner's equity, which you see in C, but you can manipulate it. So you can say that assets equal total claims against the assets, because liabilities and capital are both claims against the assets. You can think of owner's equity as a residual claim. So if you take assets minus liabilities, you get owner's equity. C is the traditional formula. So all of them, so the accounting equation can be expressed in all those ways. So correct answer is D, as in dog. Number 5, if expenses are paid in cash, then what happens? So remember, these first 5 questions were drawn from chapter 1. So back in chapter 1, we recorded everything in columns, and we asked ourselves what accounts are involved and whether they are increased or decreased. So if you pay expenses in cash, then what happens is you're going to reduce the asset account cash. And you're going to reduce through the expense. You're going to actually reduce owner's equity. So the only one. So think of the right answer first, and then go looking for it. So if expenses are paid in cash, then what happens is that D, the assets will decrease because you're reducing the asset cash. And then the last one from chapter 1, an income statement. An income statement is the one that shows revenue minus expenses for a specific period of time. Remember, the balance sheet is at a point in time, it's a picture, and the income statement and the statement of cash flows and statement of owner's equity covers a period of time. So the income statement presents revenue and expenses for a specific period of time. Looking at the other choices there, changes in owner's equity, that would be the statement of owner's equity. Reports changes in assets and liabilities and owner's equity over a period of time. Closest thing to that would be the balance sheet. Reports assets, liabilities, and owner's equity at a specific date. That's also the balance sheet. So the definition of an income statement there is D. It presents revenue and expenses for a specific period of time. So those are the first 5 questions from chapter 1. Chapter 2 we introduced the concept of debits and credits. So there were rules of debits and credits. We had the rules for the left-hand side. We had the rules for the assets. And on the right-hand side, we have the rules for the liabilities and the owner's equity. And remember, the assets, the rules were different. Remember what the analogy of driving in the Caribbean on the different side of the road. The rules were different. So it says credits. What could credits be? Well, you want to decrease assets. To decrease an asset, you credit them. And also to increase a liability, you would credit it as well. So there was a real key slide there in chapter 2. In the key slides, I forget which number it was, but remember I did put together the key slides, and that's got all the rules of debits and credits. So if you're still fuzzy on those rules of debits and credits, you might want to go back to that slide. So the correct answer here, 6, is B as in boy. 7, the normal balance of an account. The normal balance of the account would be however you increase the account. So asset accounts, for instance, would be increased by debit, so their normal balance would be a debit. Liability accounts would be increased by a credit, so their normal balance would be a credit. So the normal balance of any account is the side which actually increases the account. So the answer there is C. So A is true. The normal balance, that would be true for asset accounts. B would be true for liability accounts and owner's equity accounts. And D, the side which decreases the account. Well, no, it's not. The normal balance is whatever side actually increases the account. So think of the cash as a simple example. So cash, we increase cash by debiting it. So any asset account like cash would be, its normal balance would be a debit. Okay, so we're into now chapter 2 here. And we're testing here your basic understanding of T accounts. So if you didn't set up a little T account when you did this one, you might want to do it now as you listen. So pick up a pencil, get a piece of paper. You can pause me if you want. So accounts payable had a balance at the beginning of the period of $50,000. So you got $50,000 on the credit side. During the month, the company made purchases on account of 35. So now that brings that balance up to 85. And they made payments on account of 48. So now you got a debit on the left-hand side of 48. So to reduce the liability, you debit it. So that would be the 48. To increase the liability, you would credit it. So that would be the 35. So you got 35, you got 50 plus 35 minus 48. So the balance would be a $37,000 credit balance. Number 9, the record of activity in the entire group of accounts maintained by the company. That's called the general ledger. So the general ledger is the book, whether it be paper or electronic, where we have all the accounts. They're maintained in something called the general ledger. And number 10, the last question from chapter 2, a trial balance may balance even when each of the following occurs, except. So what we're getting at here is what type of errors will the trial balance catch? So if you forget to record a transaction, I forgot. So you forgot to do the debit, you got to do the credit. It's not going to catch, trial balance is not going to catch that because you're missing both the debit and the credit. Sometimes you like an entry so much you post it twice. Well, if you record the entry twice, you recorded both the debit and the credit twice. So that's not going to cause it to be unbalanced. Incorrect accounts are used. Well, if you debit and credit the wrong accounts, as long as you got a debit or a credit, debit and a credit, that's not going to cause it to not balance. A transposition error is made. Here's when you record 67 as 76. So a transposition error would be an error that the trial balance would collect. So the answer there is D. Okay, so now we're into chapter 3, where we learned about the time period, and we learned about the need to do adjusting entries and closing adjusting entries and the limitations of the trial balance. We learned about the adjusted trial balance. The time period assumption. Time period assumption, remember I told the story about years ago when they would get a group of investors together, build a ship, send it to the Orient, bring it back with all full of spices, sell all the spices, sell all the ship, then they would do an income statement for that period of time. So under our economic system and our financial reporting, businesses have to come up with artificial time periods for financial reporting. So the maximum period is 1 year. Sometimes companies do quarterly financial statements, sometimes they do quarterly, but the time period assumption is that we make the assumption that the life of a business can be divided into artificial time periods, whether they be a year, quarter, or a month. So the correct answer there is D. That is the definition of the time period assumption. By the way, at the back of each chapter, I believe they give you a list of new terms. So it's good to know those definitions. And remember, in Wiley Plus, you got the flashcards. Fiscal year of a business is usually determined by the business itself. So it's the business that determines the fiscal year. And remember, a company will choose a fiscal year. There's a good reason why most big retailers have fiscal years at the end of January, because that's their slow period of time. So a company will generally want to have the end of its fiscal year at the slow period of time of the year. Minimizes the disruption to the business, minimizes the amount of inventory they have to count, and so forth. Okay, here's a good adjusting entry example here. The balance in the supplies account at June 1st was 5,000, so set up a T account, put 5,000 on the left-hand side. Supplies purchased during June were 3,000, that brings it up to 8,000. And supplies on hand were actually 3,500. So if you, before the adjusting entry, it's got a balance of 5,000 plus 3,000, it's 8,000. You counted it up and they only have $3,500 in there. So the amount that was used up is the difference. So the actual entry there would be a debit to supplies expense and a credit to supplies for 4,500. 14, failure to prepare an adjusting entry at the end of the period to record an accrued expense. Well, you forgot to record an accrued expense. A good example of accrued expense, for instance, would be when you had unpaid salaries, where you debited salaries expense and you credited salaries payable. So as you answer these ones, and it has to do with the journal entry, it's a good idea to come up with the journal entry first and then look at your answers. So if you forgot to record the adjusting entry that involved a debit to salary expense and a credit to salaries payable, what would have happened? Well, you would have this failure to record an accrued expense. Okay, so what basically happens here is the correct answer is C. You'd end up with an understatement of expenses because you didn't debit salary expense, and an understatement of liabilities because you didn't credit salaries payable. Let's take a look at the other ones, why they couldn't be true. Net income is understated? No, because if you forgot to record the expense, you've actually overstated net income. An overstatement of assets and an overstatement of liabilities. Actually, you understated the liabilities by forgetting to record salaries payable. An overstatement of expenses, well, that's not true. You forgot to record salary expense, you understated salary expense. So correct answer there by itself is C, and also by elimination. 15, which of the following statements relates to the adjusted trial balance is incorrect? So the adjusted trial balance is the trial balance we prepare after the adjusting entries, and we're looking for the one that is incorrect. It shows the balances of all accounts at the end of the accounting period. That's true. It is prepared before the adjusting entries have been made. No, the adjusted trial balance is the trial balance after the adjusting entries have been made. So we're looking for the one that's incorrect. So answer there is B. It provides the equality of debits and credits. No, and the credit balances in the ledger. It proves the equality of debit balances and total credits in the general ledger. That's not really its purpose. Okay. So we're looking for the one that's incorrect here. So it's prepared. So C actually is correct. D, financial statements can be prepared directly from the adjusted trial balance. So all these things here are true with the exception of B. It says it's prepared before the adjusting entries have been made. The reason we call it the adjusted trial balance is it's the trial balance after the adjusting entries. Okay, now we're into chapter 4. Here's where we learned about the worksheet. Here's where we learned about closing entries. Here's where we learned about a classified balance sheet. A worksheet can be thought of, it's not a permanent accounting record. It's not part of the general ledger. It's not part of the journal. It's simply a tool used by accountants to help them prepare financial statements. So the correct answer is B. Closing entries. Closing entries are the salmon entries. These are the entries that bring the revenue accounts and the expense accounts down to zero. They bring the balance of drawing down to zero. We make closing entries. Basically, the purpose is to the transfer all the revenues and all the expenses to owner's equity. So let's see if that's one of the choices. Closing entries are made in order to terminate the business. No, to terminate the business. The closing entries are made to bring the temporary accounts down to zero, so that all assets, liabilities, and owner's capital will have zero balances. No, the permanent accounts are not brought down to zero. Assets, liabilities, owner's equities are the permanent accounts. It's the revenue and expense accounts that are brought down to zero. How about C? In order to transfer net income or loss to owner's drawing, to the owner's capital, that one is true. And we don't do closing entries for purposes, so the financial statements are prepared. It's the adjusted trial balance that gives rise to the financial statement. So best answer there is C. Closing entries are prepared before, the correct answer here, closing entries cause the revenue and expense accounts to have zero balances. That's what they do. And the accounts that we close out are all what we call the temporary accounts. So closing financials, remember the big flow of accounting data, all the different transactions. So we actually prepare the financial statements before we do the closing entries. The closing entries have no effect on the permanent accounts, and it doesn't summarize the activity in every account. So the correct answer is C. Closing entries bring the balance of revenue and expense down to 0. Get ready for the next year. Final step in the accounting cycle, that is the post-closing balance. So when we're all done, we've done the adjusting entries, we have prepared the financial statements, we've done the closing entries. The last step in the accounting cycle is the post-closing trial balance. And remember, I said I'd give you $20 if you could find a revenue or an expense account on the post-closing trial balance, and I kept that $20 because the only thing that appears on the post-closing trial balance would be the permanent accounts. And the last one, an intangible asset. This is something that the company owns that lacks physical substance. And it's things like this would be patents, copyrights, and goodwill. So let's see which of these is true. Does not have physical substance, yet is often very valuable. Well, that is true for intangible assets. B is worthless. No, that's not true. Patents can be quite valuable. Is converted into a tangible asset during the operating cycle. No, that's not true. They pretty much stay as intangible assets, cannot be classified on the balance sheet because, so that's not true. So the correct answer there is A. All right, so that's the multiple choice. Now we've got 4 short little problems. And basically no surprises here. So the first one, I told you would have to do journal entries, and sure enough, you had journal entries. So they gave you these, identify each transaction by number. You may omit an explanation of the transaction, so you don't have to do an explanation. So the owner invested $38,000 cash to start the business. So that's a debit to cash and a credit to owner's capital. Some of you credit stockholders' equity. This is an individual, it's not a corporation. So the correct account there is stockholders, is owner's equity, owner's capital, or owner's equity. Hired employee to be paid, that's like paid, it's paid. It's paid in Southern, paid $500 per week starting tomorrow. Well, you hired the employee, you actually haven't paid him yet. So there's no effect on the accounting equation of hiring an employee. It's only when you start to pay the employee. So for 2, there is no transaction. 3, paid 2 years rent in advance. Anytime we pay rent in advance, it's prepaid rent, the asset. So debit, prepaid rent, credit, cash. Number 4, paid workers wage 500. So when you pay workers or pay wages, salary and wages 500, credit, cash. And last one here, recorded revenue earned and received for the week, $2,900. So you debit cash and you credit service revenue. So you've got to be able to do these journal entries. No great surprise. You're going to see journal entries throughout the rest of the course. You're going to see them throughout the rest of your, anytime you take accounting, there's going to be journal entries. So journal entry looks like this. You got the debit, you got the credit. Some of you got confused and started to, show me T accounts here. I gave you partial credit for them. It says journalize the following transactions in general journal form. So this is general journal form right here. 22. So you're given the list. There's some accounts in their balances in the trial balance are listed below. Right? So now this is not a complete trial balance because you can see here that the debits don't equal the credits. It says debits don't equal because it's a partial listing of the accounts. So you're given this information here, and what you've got to do is use the above additional information, prepare the adjusting entry. So we know these balances are incorrect. We've given this additional information here. So we've got to record the adjusting entries. So the first one, we have a physical count of supplies revealed $1,400 on hand. I look at supplies that had $3,200. I've only got $1,400 on hand, so $1,800 must have been used up. So I debit supplies expense, I credit supplies. 2-year life insurance policy was purchased on September 1st for $3,600. So $3,600 for 2 years, that's 24 months. So that's 20, if you take 3,600 and divide by 24, you get 150 a month. It was used up. And I purchased the policy on September 1st, and we're doing the financial statements at September 30th. So it's a debit to insurance expense and a credit to prepaid insurance. 3, equipment depreciates at $3,300 a year. So for the full year depreciation, it would be a debit to depreciation expense $3,300 and a credit to accumulated depreciation. But it's not for a full year, it's for 1 month. So you take $3,300, you divide by 12, and that's how you get to $275. And the last one, the amount of rent received in advance that remains unearned is $700. So you had unearned rent of $1,200 as rent that had been received in advance that was unearned. And now $700 of that remains unearned, which means $500 of that must have been earned. So there's your debit to unearned rent and a credit to rent revenue. Okay, next one was you had to do the closing entries. Okay, using the information from the income statement, prepare entries to close the revenue and expense accounts. So they've given you an income statement here. So some of you rewrote the income statement. That was not what you were asked to do. Always read the instructions carefully here. It says, prepare the entries to close the revenue and expense accounts. Okay, so close the revenue and expense accounts. I got revenue, which would have a credit balance of $8,500. So to close that, you debit service revenue and you credit income summary. So remember the closing entries bring the balance of the revenue accounts down to zero by debiting them and transferring the income summary. And then the expense accounts, these are, you do one entry, you don't have to do a series of entries here. So you want to bring all the expense accounts down to zero: salary and wages, rent expense, and advertising expense. Those are the accounts that are expense accounts with debit balances. So you credit all those and then you debit income summary. Right? That's as far as you had to go. If I asked you to, there are other closing entries here. So you could have then, if you went further, you would have closed out the balance of income summary to capital. And if there was drawing, you would have closed that out to capital as well. But we didn't ask you for that. We just asked you to close out the revenue and the expense accounts. So there's the closing out the revenue. There's the closing out the expense. And the last one was really a gift. You may recall in the practice exam, I had you do the full classified balance sheet. Here, I kind of gave you a break here. I said, prepare the current asset section of the balance sheet. So the current asset section, you had to figure out, to do this, you had to know what a current asset is. So it's either cash or something that's going to be converted into cash within 1 year. And this is listed in order of liquidity. So it would be cash, accounts receivable, supplies, total current assets is $7,100. Some of you insisted on doing the whole balance sheet, classified balance sheet. And if you did the whole classified balance sheet and you got the current asset section correct, I gave you pretty much full credit. But all you were asked to do was the current asset section. So a number of you had things in here that didn't belong there. So again, the current assets are either cash, are going to be converted into cash within 1 year. So things like equipment and owner's capital and revenue and stuff like that, they're important, but they're not part of the current assets. Okay, so I hope you found that review useful. And as I mentioned, there will be exams 2 and exam 3 will be similar in content. Format is exam number 1. So please get used to the discipline of that type of exam. And I hope I made my point of the value of the importance of getting the full value of the practice exam by doing it in advance and then coming to class to go over it. That'll help you. So I hope you do that next time. Also, please add to your study routine doing the multiple choice questions at the back of each chapter. So with that, I will say au revoir, hasta luego, adios, and I will stop recording and we'll see you again soon. Keep an eye on, I'll miss you tomorrow night, recording this on Tuesday morning. I'll miss you tomorrow night, but keep an eye on Brightscale because I'm going to post some more stuff for you. Be well, everybody. Bye-bye.